Hello, everyone. Welcome to another episode of the Index Podcast. And this is a very special one. For those who are watching us, we are actually in person at Zoo Garden in Thailand. So Zoo Garden is a pop-up city organized by some people around, or like flying up close to Zuzadu. It's inspired by Zuzadu. And yeah, here I have it with me, of course. Denning on Jacob Festival. Hi. Hi. Hello, we resident data also at Drinklight, GM, and who's the crypto native at Bitwise.
Hello.
And I am, of course, Boxer, and I am the community powers at Dune. So Hong works at Bitwise, and of course, ETFs are all the rage at the moment. And so we thought this is the perfect moment. Are the institutions coming? What are we doing? How's the space going to progress? And I think Dobby has, of course, built the best data coverage and all of these on the Ethereum ETF and the Bitcoin ETF. I mean, of course, only from the on-chain side, there's some kind of TradFi reporting that probably works a bit better. But yeah, before we fully get into it, nothing we say here should be relied upon as legal, financial, investment, tax, or even life advice. And we are acting independently of our professional worlds in this capacity.
Hong, you work for Bitwise, one of the issuers of Bitcoin ETFs, which have been all the rage this year and have been a big part of what's going on, I think, in the crypto space, and are a sign of institutions finally being able to come in this space, which is awesome. We're all for it. So first, let's look at some high level metrics of how what you guys are doing. So far, I think there's you have around 40,000 Bitcoin under your control for ETFs and 100,000 Ethereum, roughly. And you have around 4% market share on both of those. What are you happy with this performance relative to maybe other ETFs? What are your reflection so far on this year and the adoption of crypto ETFs in the space?
Right. Yeah. Thanks for having me. It's definitely been amazing to see, and we're very happy with the market share that we have and the kind of acceleration of the space. So I started Bitwise with my co-founder back in 2016, about 8 years ago. I'm the CTO, and the funny thing is that we started then with the idea, even back then, that Bitcoin ETFs were around the corner. Even in 2016, 2017, people were already, the Winklevosses had filed Bitcoin ETFs and they were rejected, but people thought that it was around the corner. And people, like my co-founder and I were thinking about, we kind of fell into the rabbit hole. Ethereum was mostly kind of theoretical at the time. It was Bitcoin. We were looking for a business to build in the space because we had conviction that kind of, it was already a lot of tech back then, but we felt that it's a there here, then there's something to do. And exchanges were already built, like Coinbase, Kraken, Gemini, all existed back then. So we thought kind of a natural next evolution of the space would be for there to be asset managers. Exchanges have like brokerage apps like Schwab or Robinhood, et cetera. That is a different business than a BlackRock or a Vanguard or State Street, et cetera, where kind of the asset managers, there's investors, and the kind of exchanges or brokerages or traders, et cetera. Anyways, so we thought that was a thesis that we started Bitwise with 7-8 years ago. And it took much longer to finally kind of like play out, largely to some extent because the SEC just didn't allow an ETF to go through for this kind of market structure to evolve. We worked on a Bitcoin ETF for 6 years in a row.
Whoa.
Yeah, we've walked through three separate applications. For each application, like about a year long in its cycle, and then a year of kind of talking to the SEC again, doing a lot of research, and then filing another one. Third time, it would ultimately determine the reality is that they lost the lawsuit. That's why it happened. But anyways, that's evading a simple question. The long answer is kind of to frame how much of a kind of moment this is, both for the kind of industry and asset class, but also for Bitwise, to finally kind of be able to serve the market that we wanted to serve, which is that people, not just the kind of people that are super early to things, or are willing to kind of jump through hoops to buy Bitcoin or Ethereum, et cetera, but people that are much more kind of in the early majority or even in the late majority around people that would kind of invest in their brokerage accounts, their retirement account for the financial advisor, institution. And that category of people are our customers, and finally reach them in the way that they are familiar with. It has been sensational. It's what we've been wanting to do, and we finally get to do it. So we're very happy with that. You asked specifically about kind of market share, and it's yes. So Bitcoin ETFs are about 100 billion in total. We have about 4 billion in our products, and we're quite frankly very happy with that. Because the SEC delayed it for a decade. We were at a weird place where we are kind of a startup. We are a much smaller player, but we're starting the same starting line. Usually how small companies compete with large companies is that you get started earlier because you have conviction earlier.
Yeah.
We had conviction earlier. We were working on it 6 years ahead, but ultimately it got delayed so long that it was so obvious, even to the largest asset manager in the world. So us, a small crypto company, and the largest asset manager in the world, starting the same starting line. So it was a pretty existential moment, and it was a tough moment. But ultimately, we came out. So about 9 issuers launched at the same time, not only BlackRock and Fidelity, that everyone knows, but also other $1 trillion asset managers like Franklin Templeton or Invesco, etc. Van Eck. Many more traditional players that have much larger AUMs in the TradFi space than we do, and we managed to outcompete most of them. So everyone was kind of curious as to like how many seats there would be in the race. Like, would everyone get some amount of assets? Would one issuer to get all the assets? And the way it turned out was amongst the new product, there was actually 4 seats. There's BlackRock. They got about like 50% or half so.
Yeah.
And then Fidelity, that got another third or so. And then there was Spark, Cappy Woods, and then us. Both of us kind of got like the 5% or so of market share. And it was a cliff. Actually, after us, products really had very kind of nominal inflows.
Yeah.
And I don't think prior to the launch, people would have expected Bitwise to be part of that. If you look at the list, there's these asset managers that have $1 trillion of, or more. And it was, BlackRock, the largest asset manager, Fidelity, kind of the largest kind of brokerage and a kind of financial firm. And then our Cappy Wood, who has an incredible line of following, and then Bitwise. So I think we're very grateful for the people that chose us in that lineup. Ultimately, Bitcoin ETFs are fairly commodity products. It's like, if you have 10 bottles of water, why would you choose one bottle of water over the other? And it's very much of a brand association and kind of of course there's fees, but BlackRock charges 25 basis points. We charge 20. They're both cheap.
Yeah.
So ultimately it's more kind of about how you feel about the asset manager, about brands, kind of what you know about them, et cetera. And we're kind of honored and grateful that 4% of the market, 4 out of 100 people were like, Bitwise, this is the product that I want to choose. And it's became a large enough category that it's all added up to be a large amount, $4 billion in the AUM at the moment. And then repeatedly similar for the Ethereum ETF. So yeah, very happy with it, very grateful, and very grateful overall to finally have the chance to be in the market and kind of compete for a large TAM.
I think that's really impressive. And I didn't mean to question the market share, more the performance of the
I just wanted to say it because
okay, super cool. I think you mentioned brand being obviously a big part of why people would choose an ETF over another. And I think you guys have done some things that differentiate you from others. I believe that's because, I'm more on the crypto side, but you have been more you've been trying to work with crypto in ways that maybe institutions aren't as transparent. So one thing you've been doing is being very public about the addresses where you hold those ETFs. Being, trying to track myself all these AUM. It's not easy. So you guys are making it easy for me on your side. So thanks a lot for this. I think it's awesome in terms of transparency. For the others, I kind of sleuth around for matching flows and, flows based on the custodian and whatever. But this helps a lot. And I wish it was a normal thing to disclose, proof of funds, proof of addresses. So I want to ask, why did you guys do this? Was it hard to even pull? Is it a heavy lift in terms of work to do this rather than like not disclosing? Do you have reflections on that?
Yes. So I'm very proud that we are the only issuer amongst the US Bitcoin and ETF, Ethereum ETF products that disclose the address of the holding addresses. And on Ethereum side, we even put ENS subnames on them to make it even easier for people to know that it is our addresses related to the ETF products. And the reason we did it's not hard per se. You just handle the step. But doing anything a little bit non-traditional or kind of traditional regulated products,
yeah,
always a lot of questions raised as to like why would you if there are any additional hours about SEC might ask you a question or your auditor might ask you a question. KPMG doesn't understand why you're doing this. Then it's some amount of like explaining yourself, having to spend time doing that. If the client doesn't understand why we're doing it, then we have to answer clinic. So it's additional kind of complexity and work, and it's whether you do it or not. I think it's just a matter of kind of whether the leadership believes that it is an important thing to do. I think Bitwise has that commitment, and the reason is because what are we doing here? These are public computers, public blockchains. Kind of one of the four things that it allows you to do is that you can have kind of public auditability. Like yes, you should trust me because generally I'm a trustworthy person, or the company who's trustworthy the company, but also you should be able to check for yourself. And that is kind of the unique property of Ethereum or Bitcoin compared to a gold or some just physical commodity. And to not kind of utilize that is a real shame. Also, of course, these products are very safe. I mean, we have a third-party custodian that is a qualified custodian that is regulated in its own way. We have KPMG is our auditor, so an auditor audits it. We have a fund administrator that separately also checks everything. This is Bank of New York Mellon, it's the largest fund admin in the world. And then on top of that, we have the SEC looking for everything. And of course, we check everything as well. So like it is one of the most, and also ETF products, you have to publicly disclose inflows and kind of total number of outstanding shares and then that's value every day. It's one of the most transparent and regulated products in the world in the kind of regulated financial space. So they are very much safe and transparent and public products. But it'd be a shame if we don't kind of take advantage of the native capabilities here. And it also kind of like, if you follow a lot of some of the kind of Bitcoin ETF related fun, there's so much fun around like Brian Armstrong is lending out your Bitcoin, blah, blah, blah. And then these ETFs like get like millions and millions of views. And yes, you could say that these people are like unnecessarily funding, but why don't, we don't need to be having this conversation if we all kind of publish our addresses and have clarity on chain. So in some ways, I think it's a shame that we don't do it more widely. And that's kind of the context and reason that we wanted to do it.
Yeah, it's almost like we are thinking this backwards, where it's like you trust KPMG, you trust the SEC, you trust the NYC Mellon Bank. It's like the data is there. Like we can just look, like Hildobby is also checking you now. And like I almost trust Hildobby the most because Hildobby's work I can actually replicate. There's been like so many cases where it's like, oh yeah, sure, we had an auditor. There's like a big German, how's it called again? I don't know, some giant German financial provider completely imploded because they were like, oh yeah, we have like billions of dollars in some bank in the Philippines. Turns out that was just like falsified data.
Yeah. No, absolutely. And publishing addresses is a pretty strong version of proof of reserves for the ETFs because with the ETFs, you have to disclose your inflows and outflows every day. And so the next business day when things are settling, there should be an exact amount of Bitcoin or Ethereum moving in or out of your holding addresses. And if it's not, then like literally the next day, people can be like, what the fuck? Why do this line not lining up? And you also can't forge that on-chain footprints easily without say having access to exactly that amount of Bitcoin or Ethereum. And also proof of reserves, usually the kind of criticism is that, well, you might have these liabilities that are like hidden and off-chain. Well, you have like the KKG and Bank of New York Mellon and SEC monitored over that. That part you can't, but you need off-chain access to verify that. So an ETF product, you already have that built into it. So if you just disclose the addresses, then that's pretty close.
Yeah,
that's like pretty close to a solid version of proof of reserves that is easily implementable for these products. So yeah, definitely, it's yes, we should. Kind of a person to say that like we should totally throw away all the trust that we have for any traditional institution or process that has its value, but also we should leverage the unique capabilities that we have.
Yeah, it is kind of like a branding exercise for you almost, where you're like, okay, like part of our brand is being very crypto native, or at least trying to do the most crypto native thing.
So we had to really like we had to like fight for a lot when ETF launches were happening in Bitcoin ETFs. Like imagine being in a starting line, the same starting line. That was BlackRock, Fidelity, Fengo Templeton, Invesco. And so we knew it was going to be tough. So like for BlackRock, they just need to show up.
Sure. Yeah.
We should it's just a single possible thing to get people to think about us or care about us. The TV ad that we made is a bit fine with the most interesting there. Once we knew that the kind of like the SEC lost the lawsuit and we kind of knew that this was and ETFs kind of application have a deadline. So we knew it, they made that in like 4 weeks or so from like start to finish. It was an insane sprint and nobody else had TV ads of that quality and that virality. But we sprinted at it because we knew that we needed some way to get like Bitwise to be top of mind for people, and for it to be talked about because we're not talked about by default, So that was an ad that we took. It wasn't necessarily crypto native in any way because we wanted an ad that we thought would play well on Twitter, but also we could play on CNBC and like TechBite people would like find it funny and interesting as well. So that was an ad for that balance. But we also needed to find ways to highlight that we are different. We are native to this industry. We care about its values. So publishing the address is one of them. Another one is that we donate to the open source vets. So Bitcoin ETFs and Ethereum ETF, we donate 10% of the proceeds of the profits of the ETFs. In Bitcoin's case, to 3 kind of funding orgs, OpenSats, Brink, and HRFs. And in Ethereum's case, we donate to the Protocol Guild and a foundation called the PBS Foundation.
Yeah.
That was, again, both because I think that is a thing that really makes sense. Ultimately, our industry and these assets and these networks are built on the foundation of open source software. So it's not really like donation in the classical sense. It's almost more like investing into your own security. Because I personally care a lot about funding public goods or that kind of making sure that our foundation is solid, but also to make it makes sense to the product and that it would highlight to people again that we have a different level of commitment to the space and we're a different brand. So we had to find ways to communicate that to the audience and we had to do things that a BlackRock or Fidelity wouldn't do that would be recognized by people that have been following the space for a long time. So it's not 50% of the market. It's not 5% of the market, but 5% of the market does recognize those things. And ultimately, who knows which of the things that we did kind of added up to that? Was it the TV ad? Was it the addresses? Was it the donation? Was it kind of our 8 years of history of like being in the space? Was it us being on Twitter, and replying to things? I mean, if all of our executives are on Twitter replying to people with questions every day, like we try to be very communicative. Ultimately, people want to understand, like, oh, why is this custody thing, or why is this the NAVs thing, or whatever. So like, who knows exactly what adds up to it? And there's no way of exactly knowing because these are kind of mass market products. But for us, there was no choice but to do everything through like SaaS to have a chance.
Yeah, I think all these things that you guys are doing are definitely drawing appeal to like the crypto native crowd. Everyone in crypto is like traumatized by FTX thing. So like proof of fund is definitely credible source. And I think like early on, people were not trusting USDT as well because people were like questioning about if you do have that amount of asset under amount of the stablecoin issue. As well. So I guess like, I'm not sure if this data is actually accessible, but based on everything you shared, do you have a sense of like how's a breakdown of like your customer, like how to say user base, and like, is it truly like more crypto native, or it actually all have like a portion of like the retail who is not even adopted to, how to say, onboarded to crypto, and maybe how that compare with all the other issuers?
Yeah, so ETF products, it's a little bit harder to know exactly the breakdown because people don't necessarily need to talk to us. Of course, we have a sales team that is going and talking to institution, kind of financial advisors. We have about a 20-person sales team in the US, for example, that does nothing but calls and meetings and events. And so we have about 4,000 or so kind of advisors and institutions and branches, et cetera, that use our products. About 15 or so like banks and broker dealers that kind of our products are approved on. And so there's a concerted sales and distribution effort. But those so to some extent, we have some confirmations as to they tell us that they bought our product, then we would know. But they don't need to engage with us to buy our product because they could just click on their brokerage or portfolio trading app and buy our product. So we don't kind of have a know for sure. But the rough sense is that probably kind of the majority or a bit more than the majority is still likely self-directed retail investors. And a lot of it is likely because either they are buying it in their retirement account. So something that we've learned a lot over the years that originally we thought, hey, there's the kind of like self-custody person, and then there is like the ETF person. But in reality, it's not that like that because everyone has a retirement account. Someone might have a financial advisor that they manage most of their wealth with, and they don't want to move it out. Maybe they have like a trust for their child, and they have a whole setup there that it's hard to open up a Coinbase account for. There's a lot of reasons that people use different vehicles for different purposes of their portfolio. So there's not a kind of strict divide between this is a crypto native investor, this is a TradFi investor. Everyone is kind of often a blended both in different contexts. So anyways, so still crypto is a large, retail is a very large portion of that. And that kind of retail investor is kind of TradFi investing portion ETF flows get. Also, I think there's a large amount of retail investors that also would have never opened up a Coinbase or Kraken or Gemini accounts. And then finally that it's in their kind of brokerage account, they feel comfortable buying. I've like heard a lot of stories like, people text me like, my mom or my dad finally. I was what one of the core devs at for example, like text me like, I've been talking about Bitcoin to my mom for like years, and finally she bought it, etc. So I think there's a lot of kind of self-directed retail that it kind of bought it for convenience reasons. And then I think there's a whole audience on the more institution or kind of financial advisor side of things that are really opening up at the moment.
Talking on that point of who is actually using you guys, you recently shared a report of evaluating essentially why some institutions aren't touching on crypto. And we'll show a graph somewhere on the screen for you to look at. But could you talk on this? I think the number one here is regulatory concerns, which I think ETFs do a lot of the work of now it's a regulated product that institutions can trust and is approved by the SEC and all this. So it's I think it's a big hurdle that was removed. What would you say was the impact of this, but also leading on to what are the next hurdles maybe we're seeing other institutions being kind of scared of or, trading carefully on?
Absolutely. Yeah. So to talk about this a little bit more reversely, I think we need to, because unbundle the institutions, the term or bucket. Yeah. That's what kind of crypto Twitter uses, and it's a meme. But it's worth kind of understanding a little bit of the segmentation there. So it's useful to think about full investable dollars in at least the United States is the world that I have the most kind of mental model for. So every dollar had its own preferences, has its own kind of limitations of where it can invest and how, et cetera. So where kind of are the buckets of all the biggest pool of dollars? So self-directed investors and their brokerage accounts, et cetera, that's about like 15 trillion or so in the United States. Institutions in the true sense of the word, like endowments, foundations, et cetera, large kind of macro hedge funds, so that's about 20 trillion or so. So that's kind of a comparable size to the self-directed investment. Actually, the largest pool, about half of all the dollars, about 40 trillion or so, is in what people call the wealth management channel or the financial advisor. And what this is most people with a certain threshold of wealth, let's say more than $5 to $10 million or so, usually don't manage their own money. They have someone manage their money for you. And that person's job is to manage money for, let's say, 10, 20, 30 clients. And they charge a fee for that. But then take care of all your finances. If you have different needs, all sorts of things. Anyways, so that kind of financial advisor managed wealth is actually the largest pool of capital, investable capital in the United States. And I think, and it's actually largely a different channel than what, like an endowment, or foundation, does, or And so I think, that's just worth kind of having a mental model for. And the reason I say that is that this survey that you're referring to is actually a financial advisor survey that we've been running for the past, I think, 5 or 6 years or so. We've been doing it every year. And so because this audience, the retail audience, and also even the institutions have been moving on crypto more earlier. Most of them have investments in crypto venture funds, et cetera. It's really the largest and slowest pool of capital, but is also the stickiest and kind of insensitive to the swings is this audience. This audience that their entire job is to not lose money for you. And they kind of put something and it's a buy and hold. It's an index fund. It's like they're not trading. They're not trying to be smart. They're not trying to beat the market. They're just trying to get a certain amount of beta exposure that the client wouldn't be upset about. And to do it in a smart and kind of efficient and kind of do it in a way that is that meets the client's investment goals. But this is kind of the largest and kind of slow adopting pool of capital. And so we're always this is for example, the largest pool of course like BlackRock's AUM example comes from this audience because they just have the most amount of dollars. So we're always curious about what's how is this audience feeling about investing in crypto. And so that we've been surveying that every year for the past 5 or 6 years or so. And what this table is showing is that we've always asked every year, like, what is preventing you from investing your client asset?
Really quick before that. So a financial advisor is your everyday Joe, just kind of has an
financial advisor and they manage the investments of that person on their behalf, right? So this would be my dad, for example. He's actually fairly financially literate, but like, let's go into a other world where he's not. He would just have a financial advisor, and that financial advisor would kind of like manage his wealth and be like, okay, like a certain amount is allocated to ETFs, a certain amount is allocated to maybe growth markets. And now there's the possibility of, global equities, some amount in real estate, some amount in commodities. And some portion of the financial advisors are thinking about crypto now as maybe 3%, 5%, 1%, depending on the client. But there are a subset of financial advisors that are actually willing to either, if the client asks, or proactively suggest an allocation. But it's always been a small portion, but it's been growing. And we always ask, okay, why do you, what is all of the people that aren't doing it, why are you not doing it? And every year, so for our survey history, the top thing has been regulatory. The one thing that they don't feel that they can kind of take the risk for their own kind of reputation and for their client's portfolio has been kind of any moment the U.S. or some large country could ban it, etc. And I think this year has been the absolute largest moment for that. Both because now we finally have already fully regulated products that really has kind of meets all the criteria for what they usually kind of use for investments. And also, of course, after the election, and also kind of all the court cases, et cetera, it's clearly demonstrated that the industry is here to stay, is above board, is now has kind of the full support of a lot of political parties and the leaders, and now the president, administration. So we're very excited to see, what next year's survey will look like, and whether it's what will be the next kind of top concern. It's noteworthy that the thing that has always been the top number one is now largely safe.
Okay, very cool. Zooming back on ETF performance. So if we look at Bitcoin, there's been roughly around 2% of the Bitcoin supply that has been absorbed into ETFs since the launch. And that is on top of roughly 3% that were already gobbled up by Grayscale in the pre-ETF approved products. But so if we look and we compare to Ethereum, the performance as a whole has been kind of relative to Bitcoin underwhelming. But so do you have reflections on this? Do you think it's because of Bitcoin's maybe overperformance in general, or is it maybe an Ethereum underperformance thing? Is it because of when it launched? There's also multiple angles to look into this. There's, factoring in Grayscale, which of course has most of the outflows, but there's also without Grayscale where it looks radically different. And there's 1 million ETH that has been absorbed by ETF products from non-Grayscale issuers. Yes. Do you have thoughts on comparing the performance of the two ETF products?
Wait, and just to clarify, when you define performance, you mean like how much percent of the assets are locked in ETFs, and like ETHs have a much lower percentage of it?
I just mean that
Generally in flows and dollars.
Yeah, exactly. Bitcoin has been a high net inflow, which has been impressive even relative to other ETFs. Ethereum is often looked at and seeing, we barely just crossed net positive inflow. Since launch. What do you think about this?
In crypto, there's often this kind of relative loss. It's not a loss, but it's relative. Then you steal here or something like that. It's just that Bitcoin ETFs have been an astronomical success.
Yeah.
It's not that Ethereum ETFs is not that. And yes, we now have this kind of way of looking at net inflows as the kind of minus Grayscale kind of outflow stuff. But in reality, so much of that is literally rotated it. Most of those are outflows, and then the inflows are just inflows. So
yeah.
Think of it, Ethereum ETFs having had a few $1 billion of inflows this year. And you're just starting to see it kind of continue and pick up. So if you just look at it in those terms, it's been a great success, and it will continue to be. gold GLD in 2003 or so was the first kind of gold ETF that was launched. And in the first year, it had $2 billion of inflows. And it was the highest, it was the greatest ETF success of all time. And even before Bitcoin ETFs, it almost had it close to a title. There's a few other equities products that can outpace that. But gold had $2 billion of inflows the first year. Ethereum is like more than that. So I just want to kind of contextualize that. We, like, relatively, it can always feel very small, but it's in absolute numbers. Like it's doing very well. But relative to answer the question of like relatively Bitcoin, why it's multiple percent. Like to be our entire sales team does about like 20,000 or so calls and meetings a year with investors in TradFi space in the US. And so we have a decent cross section of like where people are, what people are thinking about. So much of crypto is like thinking about like Ethereum versus Solana, or like Solana versus Sui or whatever. These people in the kind of traditional pools of capital that I talked about, financial advisors, institutions, etc., they're barely thinking about Bitcoin. They're now mostly, I'm like, they're barely thinking about Ethereum. Like Solana, not even on their radar. They're thinking about this thing for the first time. And when you think about something for the first time, you mostly think about the biggest thing. Mm-hmm. Like, if you think about NVIDIA, you're not thinking about like what is the next GPU provider and like second and third and fourth. So there's some amount of like where we are in this journey where we're kind of breaking through the adoption cycle, so the early majority. Mm-hmm. And the early majority is actually just thinking about crypto in a serious way for the first time. And it just that like so Bitcoin gets a disproportionate amount of attention and is where people start. So it is just not a surprise that it also has been doing well price performance wise this year, which is incredible given the size of market cap that it has. It also is a case that it was the first. It also is a case that Ethereum launched kind of in the summer lull. So all the things that you mentioned kind of add up to it. But so it's I think that's kind of what paints the picture there. But Ethereum ETFs will do great, and they already are doing great. So that's kind of like how we think about it, and how I would do the space.
Yeah, I was trying to answer the question from the angle of this is how it's been framed a lot on crypto Twitter, and that's probably a large overlap with our audience. So that's what I wanted to get at. But I definitely agree with you where you can't compare yourself to different products that don't even compare or even in the same range. And those sorry, go ahead.
So one more thing that I would say is that crypto has largely managed to penetrate into the self-directed retail line, 15 trillion as a capital. For the 20 and then the 40 trillion, penetration is very low. And it will be a thing that plays out for at least a decade. And let me just put that into a little bit more context. I talked about GLD first year, $2 billion inflows. And it was a historic event, and people thought that, okay, this event has come and gone. People that have been waiting to buy an ETF form of gold for decades now finally had a chance. And so it's a $2 billion. Great. It happened. Next year, what do you think of the inflows? It was about $3 billion. The cumulative the following year was about 5. Following year, I think it was about 7 or so. It had higher annual inflows for about 7-8 years in a row. Why does that happen? If you think of the kind of investment world as like everyone evaluates everything perfectly and makes the full allocation for all of their clients at one moment, then of course, the moment it becomes available is the moment that everything is allocated and it's over. Mm-hmm. But that's not how the kind of actual money management and investment works. That's how it works for maybe your portfolio or parts of your portfolio that you use to punt. But yeah. Even for if you think about retail, it took like 3 cycles for them to get a fair amount of penetration, right? And this, but there's more kind of structural reasons. Like, for example, when I talk about these financial advisors, like four firm that has the most amount of managed wealth, it's called the wirehouses. They have kind of their own category. It's Morgan Stanley, Wells Fargo, UBS, and another one. And those wirehouses, for example, none of them has Bitcoin ETFs approved, let's say, products that the advisors can actually allocate their client money to without the client's. So right now, it's only a product that you can allocate if people. It's like if you it's not like a product isn't even on the shelf of Walmart. Like you have to go and ask the store manager to buy it. The level of exposure that Bitcoin ETFs have at the moment, because even though we think Bitcoin completely uncontroversial, like more, it's like the kind of like rock, whatever. It's not that way. And so it's have the level of like display and like acceptance of like not even being on the shelf at the moment. That is, and you have to like ask the store manager. Next year, with the current adoption price levels and the regulatory clarity, probably next year will finally be more on the shelf. Anyone can kind of say, "Oh, I want that in my portfolio," and then there's no kind of so there's these platform things, and then B, even in our we was in the 20,000 conversations, about 4,000 firms use our product in the United States. Even for the people that are financial advisors that are using our products, they're doing it for their kind of risk-heavy clients. Mm-hmm. So like if you have 30 clients, you just have to put Bitcoin to everyone. You just put it as top 5 or top 10 in terms of risk appetite. And you don't start at the highest allocation, even for that risk appetite. You start at 1% or 2%. You don't go to 5. You don't go to 2. Because again, you're like tiptoeing. So the way it works is, it's mostly not even available for the most pools of capital in that kind of world. It's the largest pool of capital. And even for them, they're doing test checks for their highest risk clients. And so that's why GLD has had higher inflows for 8 years in a row, because everyone tried it out. Oh, it didn't blow up. Oh, it was added to the portfolio. But it's a higher allocation for more of my clients. And then, okay, then now Morgan Stanley is open to it. Now Merrill Lynch is open to it. And they now start getting it. And everyone, all these things kind of add up to journeys. And it's to fully penetrate and kind of exhaust that opportunity, it's a thing that kind of takes like a decade or so to do. So I would just keep that time frame in mind, because in crypto, I think everyone thinks about things as like market events. Oh, ETF launch happens. Now what is the next trade? But in terms of kind of the ETF launch, it's better to think about it as like a state change, not like an event, but a state change. So it went from like, it's an IPO moment. It's like you go from private market liquidity to public market liquidity, and then the public market liquidity has an entirely new set of pools of capital that it has access to, and then penetrating that will just take like a decade, and that's good. That's great. That means that there is a lot of money that still can get into and buy your bet. Well, like not enough. So that's kind of how I would recommend people to kind of think about it. So even in like how are Ethereum ETFs doing context, like it has barely begun to things.
Yeah.
And as all of this gets more adopted, of course, people will start looking at Ethereum as well. And yeah, it will have a great journey.
Yeah. Well, what's the relationship between the wirehouses and those financial advisors who are not able to proactively advise their clients on this?
So like a Morgan Stanley advisor have to follow the rules of what the whole office of Morgan Stanley in their New York office that has the full and compliance and due diligence team that decides which products people can buy or can recommend to clients. They are limited by what the home office decides, because they are a Morgan Stanley advisor, and the client is a Morgan Stanley client. So the SEC kind of allowing a product to trade on the New York Stock Exchange, like the brokers act, you do it, like the Robinhood or an E-Trade or Slot. the moment it's on an exchange, then usually that's their job. They give the option for trading for their clients. But usually these wealth management firms have another layer of their home office needs to decide that it is appropriate for their advisors to use for their clients, because just because something is like some sort of like 3x leverage, I don't know, like marijuana ETFs is on like Canada, they don't want fighters to be aping into that. So the universe of ETFs or kind of equities that trade on exchanges are usually much larger than what these wirehouses or kind of large wealth management firms allow to be bought by the advisors. It's not that surprising that they've been kind of holding off a little bit. Usually due diligence takes like 12 to 18 months or so. Yep. We're kind of at a time where the due diligence of, it's now, from the home office's perspective, okay, it's now been live for about a year. Nothing is broke. They've taken a lot of money in. These products have a lot of AUM and liquidity. They're fully regulated. So now kind of everything is like on a green check, and probably they just need a little bit of like okay, our clients, like we can't be late up to this thing. Like the Schwab CEO today or yesterday had a quote on an interview about saying that he feels kind of silly. Okay. And if he would be adding spot trading to Schwab. Schwab is finally so I think this type of like, okay, Morgan Stanley feels silly that they don't have Bitcoin ETF on there. Like that feeling is silly that we don't allow it for our clients or an advisors moment is like imminent for everyone.
Yeah.
And so then I think it will become possible, and we'll see kind of a tidal wave of money from those types of behavior changes.
Yeah. And that opens then the 40 billion coffers of the financial advice, or 40 trillion. And just to contextualize that, I looked up earlier, the total crypto market cap at the moment is 3.2 trillion or something like that. Yeah. So it's like, just to kind of put that in relationship, that's a lot of fucking money.
It's not going to put, like their money. Yeah.
No, but even like 10%. Yeah.
Even a 1% on that pool of capital is because it is the largest pool of capital in the world. Yeah.
Yeah. Do you also think this has to do with kind of like wealth is shifting to younger generations? So it's like, and younger generations are way more crypto native. Are you guys doing any research on like, or can you get that data of like what age groups are typically kind of buying these Bitcoin ETFs, or is that something that's totally obscure?
We don't do the survey by age, but generally we do have a sense. There are a few other kind of data points. I think Schwab had kind of published some surveys around kind of like which products are popular in their retirement account by age, and like this is a few years ago, and like GBTC was up there for like younger people, and so I think it is undeniable that that the younger you are, the more likely you to be invested in crypto. Yeah, so that's also kind of a trend that is in the favor of our industry. These things don't, kind of demographic changes don't show up in like a year, but they show up in a decade. And in a decade, most of the wealth will be a lot of the wealth will be transferring over to millennials. Yep. And it will be a meaningful moment.
Yeah. So to your like original question, I feel like undeniably, Bitcoin as an asset is still outperforming Ethereum in general. So like, it's not a surprise that like Bitcoin ETF is also more indexed by people. Another thing is I'm thinking like, if you adopt the idea of like investing in crypto or investing in Ethereum related assets, but then there's so many more things on Ethereum network that has potentially a higher return. Like there's so many like yield stuff for like restaking, staking. So then like if I do want to hold some ETH related assets, why would I go ETF rather than like I'm going to like stack up all these yields? Maybe that's a reason too.
Speaking of Bitcoin's performance, I think we're about to break $100,000 for Bitcoin. Around now-ish.
Yeah, 99.
99.9. So, 99. Sorry, my bad. That was my bad.
For a few hours. Yeah. So Yeah,
Yeah. Okay.
bye. That makes sense.
So yeah, there's definitely different, like, even playing fields around these crypto. I just mean that, if you look at the people we work with and the people we talk to, we tend to be in these echo chambers that don't necessarily reflect the whole truth and are a very, very narrow, slim part of what is actually happening. So it's important to zoom out. And even in this space where things happen like extremely fast, we tend to be short-sighted and be like overestimating the importance of the past 3 weeks relative to the rest, when it's more about the long-term situation. I think short-term stuff is great and is interesting, but I think it's about what stays and what is going to be more permanent in this space. And that's more what I'm building towards personally. Bitcoin, 2% of the supply has been gobbled up into ETFs. And
going to it all now.
yeah, and if you extrapolate the last like 2 weeks performance, which is a metric I've been looking at, into a yearly kind of net flow, it's about 8.4% that will be absorbed in the coming year. That's, of course, you don't usually extrapolate 2 weeks on a year, but let's say this happened. It's probably not going to happen. It doesn't matter. Is there a percentage at which you would feel uncomfortable with Bitcoin ETFs, being like X% of the total Bitcoin supply? Is there a percentage you think is maybe irrationally high? Is there a concern there? What do you think? Yeah, and I have some follow-up questions there as well.
So it'll be interesting to see where the full chart states where we get to. Of course, kind of we can have a higher dollar inflows, but if the price of Bitcoin is higher, then the amount of supply that it will kind of shrink. But at some point, it will reach kind of an equivalent. I forget what it is for gold, the total supply that is in ETFs. Maybe it was something like 15% or 20% or something like that. It's not a large. It is not the majority. It is not like 40% or something like that. It's a kind of minority percentage.
Mm-hmm.
And if the 5% that we have now gets to 20%, we should kind of care to our protocols and networks in a way that it can survive that.
Yeah.
But also, what I will say is, think of the ETFs. So one of the main kind of structural issues of the product at the moment in my mind is that people can't redeem in kind. Right now, these are kind of the SEC made them to be kind of cash create and redeem products. Like gold ETFs, for example, there's a gold ETF where you can redeem to kind of have the gold sent in bars and pointing to your door.
Okay.
And if without realizing a tax evidence, et cetera. And so that's not allowed in ETF products. It's just that for the Bitcoin ETFs, the kind of rules and additional things that the SEC has applied on top of it kind of prevents those things to be possible. Like staking is another thing the SEC has said that like no fucking way. And so these cards are a little bit kind of hampered at the moment. If we get to a point, for example, where we could facilitate that type of inclined redemption, then the ETF is just kind of an on-ramp and off-ramp of its own. It becomes kind of like a Coinbase or a Kraken or et cetera, where maybe it's an even easier version of that, because you have to open up a new account or move money. You already have money there, and you can just tap a few buttons and buy some Bitcoin. And then if you're ready to self custody or price goes up to a certain point, and you kind of want to kind of go to that rabbit hole and you're ready to do that, then you can kind of redeem and take it into your ledger or something.
Yeah.
And if that becomes all possible, then ETFs are just kind of the easiest top of funnel on-ramp for the average investor. And in terms of a custodial model of investing, like not your cheese, not your crypto, like that's all true, but that's not where everyone begins their journey. So for the beginner's journey, it's actually a very transparent and very well regulated. And if you publish your addresses, a product that also had a very clean, siloed proof of reserves as well. And I think there's an argument to say that it is actually the best on-ramp and off-ramp that we could have. Of course, we're not there yet. And that's kind of the main kind of product flaw that's my perspective as someone that is kind of rooting for this movement, these networks feel about in ETFs, but we will work through them. There's no reason that we shouldn't be able to get that end state, given that is the end state that we are with, for example, with ETFs. Short answer to your question is that we should build our protocols in mind such that if 20% of the supply is in kind of these more traditional products, it can still operate well. And also, we should continue to push these products to be in a structure and a feature set that is conducive to be kind of compatible with kind of interacting on chain.
Okay, I have another question. For ETF, issuers choose a custodian. Fidelity chooses self-custody. VanEck chooses Gemini. 21 Shares used to only use Coinbase custody, but now also use Gemini, I believe. And the rest generally uses Coinbase custody. Do you think, I talked to some large investments firms, and they talked about what I could track, which would be cool if I knew how, which I'm thinking about, is kind of custodian spread of these ETFs. When there's one, it's pretty easy. When there's multiple, it gets tricky because those tend to not necessarily be published. Are you worried about Coinbase custody taking, too large of a share of these products in their own custody? I think it's also a theme in other places of the space where they tend to be a prominent actor in the space. What do you think about custody risk and point of centralization? Are you thinking of eventually having multiple custodians? I think it's a concern for like the traditional space of when we pull money together and in large amounts. Where do we want to spread it so we minimize our risks? And usually that's hopefully across multiple custodians. What are your beliefs in this?
Great question. Coinbase absolutely sweet. Largely because they're absolutely really great, have an incredible security track record, and also have been kind of securing a huge amount of crypto even before Bitcoin ETFs. The player that can really demonstrate that they've been doing that for a long time is singularly quite one of them is Coinbase. There's probably kind of a handful more that you could kind of put in that category that is also kind of a qualified custodian that meets kind of the regulatory standards, et cetera. But in the launch moment, you were trying, if it was a trace in like November, December, and January to work with the SEC. The SEC turned from like not talking to you to replying to you every week to get things moving.
Yeah.
And you were like, you were like racing to that SOC to get your filing and everything ready with them. You did not want to be the issuer that has anything that is non-standard. Like you did not want to be the issuer that has a custodian that they haven't heard of. Because ultimately, like Coinbase is a public company, and also BlackRock chose Coinbase, and so like SEC was very familiar with them, and so it was just the clear choice to go with. I do think the kind of roadside custodian model will likely be more of where we settle out.
Yeah.
There will be kind of larger players, and there's a good chance that Coinbase continues to be a large player. But will it have the absolute dominance that it has, or will it just be kind of like I do think that it will spread out a bit more than what we have now. Yeah, but it can, and we should be mindful of it. But as a fiduciary, we do think a lot about the marginal benefit of spreading things out too much, because that's more kind of operational complexity that can be problems. Also, our job is not to not lose everything. It's not to not lose anything. So there's decent kind of importance to be very careful. So I think this kind of custody thing is likely to be like any other kind of product or business category, there will be leaders and there will be concentration around the leaders. Yeah.
One question on this, super interesting. So maybe we close it down with that. It touches on another, the custody question touches on Coinbase also owns a large pool of staked ETH, and current ETH ETF products eventually will probably allow for staking, right? How does that work? Is Coinbase going to do all this? I think you guys also recently acquired a testant. What is your goal here? Is your goal to eventually manage it all yourself? How do you vision, let's say tomorrow the SEC allows for staking for Ethereum. What happens? What is the landscape like?
Yeah. So something worth noting is that Coinbase does run Ethereum validators and stake themselves. They acquired how many called Bison Trails and then kind of built it out further with Coinbase Cloud, and they now stake for a lot of the networks, etc. But they don't stake for all of their ETHs that they have. Yeah, already is an open architecture, and they're also kind of a testant, for example, it's an Ethereum staking company that we acquired. This is public information because Coinbase disclosed it. Is one of the providers that stakes for ETH on Coinbase's platform.
Okay.
Already, it is kind of they spread it out a bit. Thinking for us, we really loved. We got to know the team and really loved the team. They have been staking Ethereum from Genesis. They only focus on Ethereum. They stake about $3.5 billion worth of Ethereum, so they're a fairly large player. And they've also been doing a lot of open source work, and are genuinely like Ethereum staking experts. And so that kind of Trinity alignment ecosystem kind of like contribution stuff we really loved. And our intention is to be kind of a steady and an engaged player here, that is mindful about the influence we have on. It's a self-custodial product. So ultimately, like the clients choose. We try to have the major decisions down to the clients. So the clients decide which MEV relay to run, or whether. So like I think we will always continue to wherever possible kind of maintain that. We will help our clients think through things, but not be making all the decisions that really have an important impact to the network ourselves. It's not a custodial staking product, we want to kind of and they will continue to kind of be doing the open source contributions, kind of the focus and alignment with Ethereum, all those things we want to maintain. And staking will come to ETFs. They're already there for Europe, and that's also something that we definitely think about. But that's kind of just a part of what we're thinking about, and we want to ultimately expand to servicing staking, and also ultimately an investment solution. And we're ultimately a kind of investment manager. We have clients that have all sorts of investment needs, and staking is something we want to facilitate them for, which is kind of the main goal here.
Okay, thank you. I could ramble on for hours. I think I could continue the discussion for hours. I think I have plenty more questions. Unfortunately, we're cut short. We just, eventually this room needs to be taken for other things. But thanks a ton for this. I also want to, again, thank you for the transparency you're putting as a product when your competitors aren't doing the same. And I hope to push towards, a way where everyone kind of discloses this, especially in the wake of products like FTX, which would have benefited from, disclosed addresses, disclosed proof of funds and all this. So thanks again. Thanks a lot for coming on the podcast. This has been awesome to have you. yeah, thanks a lot. And I'm sure we'll see you again in many places, many conferences, just like this one.
Yes. Thank you. Thanks for having me.
Thanks for listening to the Index podcast. We will see you again in 2 weeks, hopefully. Bye-bye.
Crypto day wizards, come join us for the parade. From Bitcoin ETF to Solana meme coin trade, uncovering public secrets in the blockchain shade. Bad chiller, cherry picking liar, we call them out and set chart crown on fire.